Good afternoon, everybody. This is Chuck Hughes. Thanks for joining us today. We apologize for that slight delay there getting set up, but I think you're going to find it's well worth your time to listen in today. And thank you, Tom, for taking the time to present this webinar. I think we have a lot of good information today for our viewers. And what we're going to look at today is two strategies that have been working really well over the last several years. And the markets in general, the last 3 or 4 years, been very difficult to trade. There's been a lot of volatility with very little trend. So it's been a challenge to produce consistent profits during these types of markets. But with these two strategies you're going to learn today, they've been doing great and will continue to do great regardless of what type of market conditions we have. So the new reality with the markets the last several years is we've had slow economic growth, we've had lower corporate earnings, lower stock returns. For example, over the past 13 years, the S&P has had a negative 2.9% return, and over the past 5 years, it's had a negative 2.8% return. So that's what you're faced with when you're trading stocks and stock options. It's the new reality is the returns just haven't been that good for the stock market. We have high unemployment, we have a lack of high-paying jobs and decreased job security, and lots of market volatility with very little trend. And I'll show you some S&P graphs here in a minute. And we have overall just a lower standard of living in this slow growth environment. So that's what we're faced with, but we've been able to prosper despite these difficult markets that we've been having the last several years. And I'm going to show a couple S&P price graphs, and what you'll notice with these graphs, what they have in common is you see a lot of price volatility with the S&P, but very little trend. And in all these snapshots that I take, despite all the price volatility, the S&P index is virtually unchanged over the time period. So here's a snapshot from 2012. Here's a snapshot from 2011, and you can see a lot of price volatility. There were 68 days in 2011 during which the S&P closed up or down more than 2%. So that's a huge amount of volatility. So again, we have lots of price swings, but no clear trend. And that's been the norm the last several years. Here's a snapshot from 2010, and over this period, the S&P only changed 2 points, even though you can see the massive price volatility. Here's another snapshot from 2011, and in 2011, the S&P was actually unchanged. It started the year at 1257, ended the year at 1257, but we had all this price volatility in between. Here's a snapshot. This was took this in July of 2012, and over the previous 12 months, the S&P was unchanged. So again, you can see that's the new norm now for the stock market in general, is a lot of price volatility, very little trend. So the question is, how do you prosper? How do you profit in these types of market conditions? So two strategies I want to focus on today that have been doing very well these last several years are covered calls, and we trade covered calls for both monthly options and weekly options, and then what I call the super portfolio. And the super portfolio is a portfolio of stocks that have been doing well in this type of market environment where we have very little growth. We have deflation and very little growth worldwide, not only in the U.S. but worldwide. So these super portfolio stocks have done well despite the slow economic growth. And we have both stock portfolios and option portfolios for the super portfolio. So right now I have over $300,000 in actual profits with these two strategies, and I'll show you my brokerage statements, my current brokerage statements showing this profit. So these strategies have been working very well the last several years despite the market conditions. So let's take a look at the covered call strategy first. And with covered calls, it's a pretty simple strategy to implement. You buy 100 shares of stock or an ETF, and then you sell a call option. So this is actually a spread strategy because you're long the stock and you're short a call option. And I'm going to show you a recent covered call trade I made, and it was for the small cap ETF. And when I purchased the ETF and then sold the call option, it allowed me to purchase this ETF at a 30% discount. So if you buy a stock or an ETF at a 30% discount, a lot can go wrong and you're still going to be profitable. Now, the way this strategy works is the short call option profits if the price of the underlying stock or the ETF decreases. And it also profits from the time decay of the short option. And anytime you're short an option, the time value of that option becomes profit at option expiration because options lose all time value at expiration. So covered call trades can profit if the underlying stock increases, remains flat, or even decreases. And I'll show you examples of that, of some recent covered call trades I made. And the example I'm going to show you here in a minute, when I took this trade, I immediately collected 30% of the value of the ETF in cash. So that 30% cash premium, of course, gives me a lot of downside protection if the underlying ETF declines in price. And a small increase in the stock price, actually in this case it was an ETF price, can result in a 53% return. A flat ETF price would result in a 42% return, and even a 20% decline in the ETF can result in a profit. And with covered calls, the risk is limited to the cost of the trade, and it's the ideal strategy for these type of markets that we've been experiencing. So let's take a look at a trade I took recently. This is for the small cap ETF, and my brokerage confirmations show that I bought 400 shares of the small cap ETF at $51.22, and then simultaneously I sold 4 of the January 2015 55 calls at $15.32. So I bought the stock, sold the call option. This created a covered call trade, and I used a leaps option for that expires in about 2 years. So what I did is I input the price of TNA. I bought it at $51.22. And then sold the 55 strike call at $15.32. So I put this into the buy right analysis, and what this does is it calculates the profit potential for this trade for assuming various changes in the price of TNA at option expiration, from a 10% increase in price to 56.34 to a 20% decline in the price to 40.98. So what we're doing here is we're assuming various price changes, and the calculator will calculate your profit or loss potential based on these changes in the price of the ETF. And we can see that at option expiration, if the ETF is up 10%, then this covered call trade would have a 53% return. If the ETF is flat at option expiration, I would still have a 42% return. And even if it declines 20%, I still have a 14% return. And the cost of this trade was $3,590 plus commission. So smaller accounts can trade these covered calls. In this example, you only needed $3,590 to make this trade. So again, if the ETF increases slightly, I get a really good return. If it just stays flat, I get a really good return. And even if it goes down 20%, I still have a good return. So this is a great way to trade volatile markets. And here's another example. This was, I bought 400 shares of the small cap at 51.10, and then I sold 4 of the January 2014 55 strike calls at 11. And these calls expire in about a year. So let's look at the profit loss potential for this trade. A 10% increase in the ETF would produce 37% return. If the ETF is flat at option expiration, 27% return. And if it declines 20%, it's a 1.9% return. So this gives you an idea of what your profit potential is before you take the trade. And I use these calculators before I take the trade just to give you an idea of the profit potential under various scenarios in the change of the price of the underlying stock or ETF at option expiration. Now, what I did was I assumed that instead of on that day that I wrote the covered call, I assumed that I had simply purchased that 55 strike option instead of selling it. So let's look at that profit potential. So again, when I did the covered call trade, I bought TNA at 51.22. I sold the 55 strike call at 15.32. So let's now assume that instead of writing a covered call, I had simply purchased that option. In other words, I purchased the 55 strike call at 15.32. Now let's look at that risk profile under the same assumptions. You know, we're assuming here that TNA goes up 10%. We're assuming in this column that TNA stays flat. And in the far right column, we're assuming TNA declines 20%. So same assumptions, except this is an option purchase instead of a covered call. So we can see if the underlying TNA goes up 10%, we're going to lose 91% on this option purchase. And if TNA goes up 5%, we're going to lose 100%. And if the TNA is flat at option expiration, we're still going to lose 100%. And then, of course, if it goes down, we're going to lose 100%. So that's a pretty big difference in risk-reward compared to the covered call. So that's the difference between these types of strategies. And the covered calls in this example is providing 30% downside protection, and they can profit in these volatile type of markets. When you have that much downside protection, you're not forced out of your stock in case of a wide price swing. If you use money management stops, when you purchase a stock or you purchase an option, a lot of times in these kind of volatile price moves, you can easily get stopped out. But with this spread, this covered call spread, with 30% downside protection, you can hold on to this position during these volatile price swings, and ultimately it can be profitable. Whereas if you just took a directional trade, you could easily get stopped out. So that's a big difference between trading these covered calls and taking a directional trade in these types of markets. When you have this kind of price action in a market, you want to be the bank. You want to be collecting the option premium instead of paying out an option premium. So when I sold that call option at 15 points, I immediately collected $1,500 cash in my account when I did the covered call, instead of paying out $1,500 out of my account for the option purchase. And again, you can see the risk profile with the covered call. If the TNA increases 10%, I get a 53% return, as opposed to a 91% loss. And of course, if TNA is flat, I get a 49% return instead of a 100% loss. So these covered calls allow you to be the bank, and you're the one actually collecting the cash for the premium in your brokerage account instead of paying it out. So that makes a big difference in these types of markets. Here's a snapshot of my advisory service covered call portfolio. This was taken yesterday, and you can see we list all the positions here, and these, in my advisory service, all these stock and option positions are updated real time every day, so you can see how the portfolio is doing. So as of last night, we had $127,000 open trade profit, and we had an average return of 86%. So that's a pretty high return for such a low risk conservative strategy. So anytime in these kind of markets when you can show an 86% return for such a low risk strategy, you know you're doing something right. So and one other thing I noticed over the years with this covered call portfolio is when we have those big down days where the Dow's down 100 points, 200 points, 300 points, your profits don't fluctuate that much with these covered calls, because once these calls get in the money, then when the stock goes down, you could have a delta on the call of 70, 80, or 100%, close to 100% once they're in the money. So what that means is if it had a delta, let's say, of 80% or 0.8, and the stock goes down 1 point, the option is also going to go down about 0.8 of a point. So instead of losing a point, you're only going to lose 0.20%, because the corresponding short call also went down, and that reduced your loss for the day. So instead of having, say, a 1% loss in the portfolio, you'd only have a 0.2% loss. Or if there was a 2% loss in the underlying stocks, you may only have a 0.4% decline in this portfolio. So this profit is not going to fluctuate that much, because the underlying calls also go down in profit when we have those big down days. So this is a great strategy for volatile markets because your profits don't fluctuate as much, your profits and losses, and this portfolio stays pretty steady and is a great strategy in when the markets are volatile. So, did you have a question, Tom? Okay. I just want to show you some real-time profits for this covered call strategy over the past 3 years, and I had over $1.1 million in real-time profits over the last 3 years, and these were in two of my most of these trades were in two of my retirement accounts. So I'm going to just show you real quickly these profit loss reports from my brokerage account showing us these profits over the last 3 years. And again, this was during a very volatile market and non-trending type market conditions over these last 3 years. And of this $1.1 million, 915,000 of it was from trading weekly covered calls, which is something we'll cover here shortly. So the weekly options started trading in 2010. So prior to that, I was trading monthly covered calls. So,
Chuck, if I can interrupt and ask you a question on the monthly, we have several of our attendees are asking, do you use a standard for time duration on your monthlies? For example, a 12-month leap, a 6-month option, a 3-month option, or does it depend on the particular stock that you're looking at?
Yeah, that's a great question. What time horizon do you look for in these monthly options? And to answer your question, Tom, I like to mix it up. I have a combination of leaps, covered calls, and 6-month, 3 months. So I like to stagger the expirations, and that allows me to diversify my portfolio and smooth out the risk in your portfolio when you vary those expiration months. And in the previous snapshot I showed you, this one, you can see that the expirations are staggered for these options. So we like to mix it up, and that diversifies our portfolio in case in any particular month you get a big down move. It's better to have the expiration months staggered over a period of time, as much as 2 years to 1 year to 6 months to 3 months.
So use a broad-based time spectrum for each one of your picks. So not the old adage, you don't put all your eggs in one basket, especially when it comes to time.
Right, exactly, yeah. So that's a great question. So you want to spread out the risk over various time periods in case you have a period where the market's down sharply. You want to stagger those expirations to spread out the risk. So let's just look at these real quick. These are snapshots of my brokerage account portfolios with covered call trades. So these were over the last 3 years. So these were pretty tough market conditions, and but I still had over $1.1 million in profits. These are, right now I'm showing you closed trade profits for the short call.